Welcome to Mortgage Minutes, where we demystify the loan process for you. I'm your host, Austin Baker, along with my co-host, Jonathan Buck. Boom, boom, boom! Let's go! All right, Jonathan, what are we talking about today?
Today we're going to be talking about what is a second lien, and more specifically, we're going to be talking about a purchase money second.
Sweet. So before we jump into that, lien, that term is something we're real comfortable with within the mortgage industry. But if this is your first time getting a home, you might not be familiar with what that term is or what that term means. So Jonathan, break it down for us. What is a lien?
So when you're buying a house and you're getting a loan, whoever gives you that loan is going to put a lien on that house. Because if you stop paying, then you're going to get foreclosed on, and that lien holder is going to get paid whatever they're owed from short selling or foreclosing your house. And so a first lien provider means that they have the first right to your house. And a second lien means that they're secondary to that first lien. And so they're in a more riskier position, but they'll get paid after the first lien provider gets paid.
Yeah, and so it's essentially the mortgage company's protection. So they're lending you the money. They need to make sure that if you stop paying, they're going to get paid back.
Yep.
So that's how liens work. And then their position is just the priority upon getting paid. So, okay, maybe you sell your house. No issues getting foreclosed on, but you go to sell. You don't make the full amount that you sell your house for. You've got to pay the banks back for your mortgages. And so the first lien, they get paid back, and then the second lien gets paid back.
Exactly.
So, and then you get your money. So in this scenario, let's just imagine that we're buying a $500,000 house, and that on this $500,000 house, you as the borrower, you only have 10% to put down. Okay, so we're going to be able to get, okay, here's our 10 that we've got right here. Call this our down payment, 10%. How do we finance the rest of this? There's really two options. You can either get a loan for the entire amount.
Yeah, for 90%.
But what are we going to have?
But you're going to have mortgage insurance, and you're going to have to do escrow, taxes, and insurance.
Exactly. And so go check out our videos on that. We'll link them to this one. If you don't know what PMI is or how that works or escrows, we got you covered. But if you don't want to pay PMI and escrows and you only want to put 10% down,
you got to get to 20%. So second lien comes in place here.
Yep. So let's imagine this is your first lien, right? And this is at 80%. So we got to keep the first lien at 80% or less to avoid the PMI and the escrows.
Correct.
So the way we get there is with the second lien. So in this scenario, we would refer to this as what?
An 80-10-10. So your first lien's 80, second lien's 10, and you're bringing 10% down.
Bingo.
So, beautiful way to not have mortgage insurance or have to escrow. A lot of people are like, I want to save my taxes and pay my insurance myself, not the servicer.
And these numbers can fluctuate, so it doesn't have to be 5 and 10. It can be, 7 and 13 or whatever. So there's a lot of flexibility, and we can help you figure out what makes the most sense for you. So this is essentially how a second lien works. It's just bridging the gap between your first lien position and your down payment to get you to the total amount you need for your purchase price.
Yeah, so essentially you're going to have two loans to get the house, but you achieve your goal of only having 10% down, and now you're getting around escrows and PMI.
Right, which brings up a good point. So we haven't seen this utilized a whole lot lately, primarily because PMI has been so cheap. And so just because you don't want to pay PMI doesn't mean that this is the best route to go. Everybody's different, and so we've got to look at the file to see what makes the most sense, how long you're going to keep the house, all that good stuff. But PMI is really cheap, so people haven't really been using this first and second lien structure as much.
Yeah, and the first and second liens have been around for decades.
Yeah, long time.
Yeah, and I'd say in the last 10 years, the mortgage insurance companies or PMI providers have been really competitive. So like Austin said, most of the time it likely makes sense for you to pay the PMI if you have high credit scores and things like that. Obviously, like you said, it's very subjective. Yeah. But those are two traditional uses. But the third one here is a jumbo loan. This is kind of a newer uses that we're seeing.
Yeah, and for timing's sake, right now we're in the middle of the coronavirus while we're shooting this video. And what's happened while we've been in the coronavirus with jumbos?
A lot of the jumbo investors and originators and lenders have totally backed out the market. So there's not a lot of people doing jumbo loans right now.
There's a lot less options. They've gotten the options that are left are not priced as good as the conforming counterparts. and they're also just a whole lot harder to get.
Yeah, the easy way to think, the box for jumbo loans have gotten a whole lot smaller. So there's a pool of people that have been taken out of the jumbo market. So they can't get a jumbo loan. So what's the workaround?
Right. So the workaround is to do a second lien.
Exactly.
So imagine that, so right now, the max conforming loan amount's just over $500,000. It's $510,400. So if you're looking to borrow more than that amount, the only option is to either get a jumbo loan or to get a bigger second to help you get further out. And so you could tack on, in this situation, up to another, with some second lien providers, another $250K here, which could bring your total borrowed amount to $750.
Yeah. That's huge.
Plus or minus.
So you could buy an $850,000 house with 10% down.
You could. And so this is what we're seeing a lot. And this is one of the main reasons we're shooting this video, whether you're a realtor or a borrower. I know that sometimes understanding how second liens work and why you should use it versus a jumbo can be hard to explain. So we wanted to map this out. This is how you do it, guys. And we're encouraging a lot of people right now to go this route, especially if you're self-employed. This is going to be a lot easier for you to do this than to try to get a jumbo loan, at least right now. So that is second liens in a nutshell.
Yeah, and just one last thing. You got to look at where the rates are on jumbos in regards to conforming.
Absolutely.
Sometimes jumbos are lower than conforming market rates, and sometimes they're at the same. Right now, jumbo interest rates are a little higher.
A little higher.
And conforming loans are at all-time lows. I mean, y'all have seen them in the news. And there are certain borrowers that are qualified to do a jumbo, but because of the interest rate, they might save money by doing a first and second lien.
Absolutely.
So it seems a little counterintuitive, but if it saves money and it makes sense,
If it saves money, it saves money.
Math is math, as Alton always says. So
amen.
There we go.
All right. If you have any questions, you know how to find us. We'll see you around.
Peace.
Adios.